Welcome back to your Mortgage Insider update this week. It's going to get worse before it gets better, it looks like. We're getting inflation reports this week. Producer price index came out this morning. As expected, it's still pretty high. Consumer price index comes out tomorrow. It's expected to be still around 8%. The Federal Reserve doesn't meet right away, but as these reports come out, it's just going to continue to bring additional ammunition for the Fed. They got a great report last week on employment. Great as in the sense more people are employed. Unemployment rate dropped to 3.5%. So they have no reason to think that the economy is in such bad straits with these higher interest rates that they can't continue to tighten, especially with the inflation numbers that we're seeing. So let's jump into the charts. So this week, 10-year Treasury is breaching really close to 4%. We had more big news. The Bank of England is still having to step in to hold up the bond market in the UK due to a lot of volatility just worldwide. That's one bit to the puzzle, and that's continually putting pressure on interest rates overall. Mortgage rates, which we have shown here, is down 12 basis points. So just to give some points of reference here, if we go back a little bit in time, so mortgage-backed securities trade as the price drops, the interest rate to the consumer is actually higher. So this is the trader's edition of like what the cost would be to buy the bond. So as an investor, you're going to pay less money for the investment, which means that you're going to seek a higher return to make it worth your while, right? So a higher interest rate to the consumer, higher interest rate to the investor. So the price has dropped as the Fed came out with their announcement in September. We saw the initial reaction. High interest rates were breaching at near 7%. We saw a bounce back from that, and then it never really recovered any farther as far as the price goes. And the price has come back down to the lows, or which would represent the highs in interest rates, which I'll describe with the 10-year Treasury. So we can see the same time period, September 26th, 23rd, right in here, we saw the interest rate jump and then settle and then jump again. And we're sitting right at these highs. These highs date back to like 2007, 2008, just to give a point of reference. Now, 4% overall is not an incredibly high interest rate for the 10-year Treasury in history, if we went back 40 years or so. But in the most recent history, it's painful. So today, producer price index, like I said, is out. It's up 0.4%. The expectation was up 0.2%. So they expected it to be higher. It's actually higher than they expected, coming in basically in the 8.7% range. Consumer price index somewhere in the same neighborhood, over 8% as expected. We'll get that coming up here pretty quick. With that, make it a great week. Call me if you have any questions. Look forward to helping you guide you through the markets and all the volatility we still have to come.